Are you paying too much in taxes on your short-term rental income? What if there was a way to turn your biggest expenses into your biggest savings? Today we're breaking down one of the most powerful but misunderstood tax strategies for Airbnb hosts and short-term rental investors: cost segregation. If you've ever wondered how high-level investors reduce their tax bills while scaling their short-term rental empires, this video is for you. We'll be walking through exactly what cost segregation is, why it's so effective for vacation rental properties, and how you can use it to boost cash flow, fund upgrades, and grow your portfolio. A cost segregation study lets you accelerate depreciation on certain components of your property, like appliances, furniture, or landscaping, instead of waiting 27.5 years to write them off. Traditionally, residential real estate is depreciated over 27.5 years, but a cost segregation study separates out parts of your property that wear out faster and depreciates them over 5, 7, or 15 years. This means you get larger tax deductions sooner and lower your tax bill much faster. The process typically includes 3 steps. First, a review of all purchase documentation and receipts to identify what qualifies. Next, engineers conduct a detailed site visit to assess components like HVAC, plumbing, or custom finishes. Finally, tax experts calculate depreciation schedules based on IRS-defined categories, giving you a full depreciation roadmap optimized for early tax savings. Short-term rentals are especially well suited for cost segregation. Why? Because hosts often invest in premium amenities to stay competitive, from designer furniture to top-tier appliances. These are all assets that qualify for accelerated depreciation. And because the short-term rental market is so competitive, investors have to reinvest frequently to stay ahead. Cost segregation unlocks cash sooner, allowing you to fund renovations, marketing, or even additional acquisitions, all while staying tax efficient. If you're reinvesting regularly to keep your Airbnb listing top-notch, this strategy is tailor-made for you. The benefits of cost segregation study are hard to ignore. Major tax savings from accelerated depreciation reduce your annual tax liability. More cash flow means you can reinvest your short-term rental faster, whether it's upgrading a bathroom or installing a hot tub. Improved ROI helps build wealth and expand your portfolio. Better guest experience leads to more bookings and higher ratings thanks to upgraded amenities paid for with tax savings. And perhaps most importantly, it helps protect you against risk by building a financial cushion to handle the unexpected. In short, it's not just about saving money, it's about gaining the flexibility to run your business smarter. Let's look at a real-world example. Emily buys a $600,000 ski town Airbnb. Included in that price, $100,000 worth of high-end furniture and finishes. With a cost segregation study, Emily classifies $30,000 in appliances, $20,000 in custom fixtures, $50,000 in luxury furnishings, and $25,000 in landscaping. This increases her annual depreciation deduction from $21,818 to $38,940, saving her nearly $6,000 a year in taxes. She reinvests that savings into a hot tub, boosting her nightly rate by $50. The result? More bookings, higher revenue, and much stronger return on investment. Many parts of your short-term rental can qualify for faster depreciation. These fall into 3 buckets. Tangible property, like furniture, appliances, electronics, and decor. Think your couch, sound system, or high-efficiency fridge. Land improvements, things like landscaping, fencing, or paved walkways. Even outdoor lighting or retaining walls can qualify. Building systems like HVAC, plumbing, flooring, and electrical wiring. Components that might be depreciated over 5 to 15 years instead of 27.5. To do this right, you'll want to work with a tax advisor who specializes in cost segregation. Misclassification can create compliance issues, so professional support is key. So how do you know if a cost segregation study is right for you? If you recently renovated, purchased a high-value property, or have a high annual tax bill, this could be a strategic move. It's especially powerful for owners of multiple short-term rentals since the cumulative savings can be game-changing. Even better, if you're actively managing your short-term rental and qualify under the short-term rental tax loophole, the impact of cost segregation gets amplified. You can deduct more, save more, and scale faster. Cost segregation plays nicely with other tax-saving strategies. Short-term rental tax loophole. Classify your income as active by meeting the 7-day average stay rule and materially participating. Depreciation stacking. Layer in operating expenses, deductions like insurance, utilities, and management fees. When combined strategically, these methods can take your short-term rental from good to great, all while keeping your tax burden low and your profit margins high. Short-term rental success isn't about the guest experience. It's also about the financial strategy behind the scenes. Cost segregation is a powerful way to accelerate ROI, boost your cash flow, and reinvest with confidence. Are you ready to take your short-term rental to the next level? You can check out AirDNA. We've got tons of tools to help you maximize your returns and make smart investing and hosting decisions. If this video helped clarify how cost segregation works, make sure to give it a thumbs up and don't forget to subscribe to our channel. Bye!